Well, as we have been reporting, the $20 billion Rogers Shaw deal has been approved by the federal government, happened basically in the last hour or so. And we've talked about what that means just in terms of the telecom landscape, but certainly investors are curious about this as well. Let's talk to somebody who's been tracking the deal this morning as well, Bryden Teich. She is a partner and portfolio manager at Avenue Investment Management. Nice to have you back with us, Bryden. What was your reaction to this? As obviously, you know, we've been waiting for clarification for upwards of 2 years at this point.
Yeah, nice to be with you, John. Good morning. I think the expectation was largely that this was going to see its way through, and I think the caveat was always, figuring out a way to piece off the one part of the business to Quebecor, which was kind of seems like it was the last sort of stumbling block. And I would say, I think the expectation, or how the shares are reacting this morning, I think it gives an indication that for the most part, this was priced in. This was kind of always the most likely outcome. And I think, taking a step back, looking at the telco space overall, I think the challenge that Rogers has had the last couple of years is they were slower to recognize the importance of 5, going back like 3, 4, 5, 6 years ago, where Bell and TELUS have now such a dominant position there, where Rogers has been in a position where it's been much more starved for growth. So, it does make sense from a Rogers perspective to try to, grow in the West now with the Shaw assets, and all of that makes sense. But I still think it doesn't change the fact that, we view Bell and TELUS both as being sort of in the dominant position. But if you're, internally at Rogers, you can understand why they would make this decision. But, it doesn't necessarily mean, I think that Rogers is in, the best shape going forward.
What are the metrics that you look at then as an investor with, whether or not you want to be an owner of one telco versus another, for example?
So, yeah, I mean, we're just for disclosure, we own Bell. We've owned Bell for a number of years. I think when we looked at the space, I think 5, 6 years ago, there was a period in time where Bell was really accelerating their capital program and building out 5 to the home in the GTA. And I think that it was sort of that pig in the python of CapEx that they were having to go through. But now they're on the other side of that large capital program. And I think the results from Bell as it relates to 5 have been really stellar. And so I think that there's been this transformational shift in the telco space of more data and more flows of data to the home, which is better done on 5. And I think there was a strategic decision that both Bell and TELUS made years ago that was going to be the future, where Rogers was more interested in media assets or what they were trying to do with their business in the U.S. Which is just wasn't clear to us that was the best strategic decision to make. And so we look at it on that perspective, where then you can look at it on valuation and all these other metrics. But I think we want to own the dominant player in the space, and for us, that's always been Bell, and that's what we continue to do.
And where do you think these kinds of investments, because these are very widely owned stocks, right? We're talking about a sector that is going through some change clearly today, but what doesn't change is there's a lot of Canadian investors who they look to bank stocks, they look to telecom stocks, in part because of things like dividends, et cetera. They're looking for that steady Eddie performance. How do these telco names perform in the kind of environment we're in? Yes, there is uncertainty right now, but we even just said, there are signs that maybe inflation is easing. Maybe we won't see a worst case scenario for the economy, even though the headlines have been kind of scary. And a lot of the big winners actually for the first part of the year were higher growth technology stocks.
Yeah, so I specifically on this telco sector, and I would even kind of group in utilities with the sector too. There's the comfort that is received by high dividend level that I think that's predominantly why retail investors love these stocks, and they've been great companies. I think the challenge that a lot of these companies are beginning to face, and if we might go through a cycle where inflation comes down, and our concern is that after that it will go back up. But when you have an industry, whether it's telco or utilities, that is highly capital intensive, their capital costs are rising with inflation. And the problem is, if that requires debt or outside financing to grow, you're then requiring more financing in an environment where interest rates are higher, and your costs are inflating much faster than you can raise prices. So yeah, I would look at the telco space in general and just say, I don't think it has great pricing power in an inflationary environment. And so because they can't raise prices as well as some other industries, I don't view the whole space as that attractive relative to other things in the in the market. And so I can understand why people like it for the dividend. And I think Bell is now yielding over 6 or 6.5%, which is great. But if you look at the stock price, I mean, the stock is where it was in 2015. And for a lot of the telcos, I mean, the share price might not go anywhere for years and years. So it just comes back to like having the proper expectations for what you want your stocks to do. And if we're going to be in an environment where interest rates stay higher, I have a hard time understanding why these stocks should go higher. But at the same time, you do get your dividends, so there's a reason to own them for that. But I'm more cautious because I don't see an argument why these stocks deserve to trade at a high multiple, and I think they're going to have persistent inflationary cost pressures.